Welcome to ACCA paper F9 on financial management. Today we want to spend a little bit of time to talk about the so-called business finance topic. Now, this is in the syllabus a reference to understanding institutionally the kinds of instruments that companies can avail themselves of when financing themselves. We can talk of sources and raising short-term finance. This would be typically money market related. But primarily we're going to talk about the long-term financial spectrum. In other words, the capital markets. This is the sources of long-term finance for a company. This is effectively what we're talking about is the capital employed as alluded to earlier. Without going into great amount of detail here, leave it to the student to go as deeply as they feel necessary to understand the different types of instruments that are issued by companies. We can start right with the ordinary or common shares, and that is the most fundamental unit of ownership in a corporation. Of course, the risk is greatest for someone who has equity exposure to a company, but of course the rewards can also be the greatest being in that situation. If we move into so-called non-equity share area, we're talking about preference shares. Preference shares come in many forms. Now they rank preferential, as the name suggests, to common shareholders. They can be redeemable or irredeemable. That means they can be redeemed by the company at a certain time in the future, or they can be issued forever. Dividends are non-tax deductible, and so on. These are main features of typical kinds of preference shares, but always be sure to check the prospectus to understand specifically what kind of preference shares one is investing in, so as to avoid surprises. They may be cumulative, they may have a convertible feature as described here. When we move beyond now, move above sort of common equity and preference shares and into the debt realm, now of course we're talking about borrowing money, and this takes many forms. Now in principle, let's remember the debt is a liability of the business. It has to be repaid, pays interest. The interest is tax deductible, and another general feature is it does not represent ownership interest in the firm. Another difference in terminology: bonds, which is the general term we use for borrowings, medium term, based on a security issued by a borrower. We can distinguish this from debentures, which would represent unsecured corporate debt. But I think we can live with the term bonds in general to denote long-term debt. But of course we have to go further than that. We have to make distinctions then whether we're talking about convertible debt, in which case the debt can be changed into shares or converted into shares at the bondholders' discretion. Subordinated loans would be loans which rank inferior to other kinds of liabilities of the company. This can be the result of certain demands made or conditions imposed by lenders. And then there are such instruments as warrants, which is a kind of negotiable security, can be bought and sold, which gives the holder of a bond the possibility to buy shares by using the warrants. If they don't want to buy shares, they can sell the warrants. They have a market price in the markets. The discount bonds would be bonds that have that are a very little coupon. That means interest being paid on them, and therefore they're bought by a strong discount to the redemption value. Junk bonds would be speculative category of bonds which have higher risk. Then, of course, the great thing about corporate finance is that they lend themselves, it's an area that lends itself to ingenuity and imagination. So lawyers and market practitioners and so on can come up with all sorts of hybrid securities as long as the conditions are well understood and described and legally, contractually defined, and as long as there are investors who are interested and willing to buy such securities, then there is really great scope for issuing new kinds of instruments that may not have been seen before. They're a response oftentimes to investor appetite. A rights issue is a specific kind of capital increase when a company is obliged to offer its existing shareholders new shares in proportion to their existing shareholding. And there follows a numerical example of how a rights issue works based on a scenario here. And the student has to, should take care in defining what the objective is of the rights issue. The company needs to raise additional money by issuing new shares. And through this rights issue, one can determine what the value of a right is, in this case. And also what the theoretical X rights price of the shares will be after the issue has taken place. So the value per share in this case after the rights issue is $9.25. The numbers here are quite straightforward and can be verified by the student. Now, there's some institutional detail that one has to be aware of, because corporate financial officers need to understand very well where and at what conditions they can access finance, long-term finance for their companies. So a placing is a specific kind of method or mechanism through which a company is able to offer its shares to a short list of institutional investors. It could be a private placement, for example, based on the preparation of a prospectus, and then addressing or contacting such investors to see if they're interested in investing in the shares of the company. Initial public offering is, as the name suggests, the mechanism by which a company makes itself tradable on a public exchange by issuing shares in a first transaction. And this is followed, this is achieved by following a number of strict steps, procedural steps that are defined by the stock exchange on which the company wishes to be quoted. Now, in this syllabus, one also has to take account of the fact that the Middle East, particularly the Gulf states, represent an important pool of savings by investors, which can be tapped by Western companies or companies around the world, provided they understand the institutional conditions that need to be followed. This is this tapping of Middle East sources of finance is known as Islamic finance, and corporate treasurers and financial officers nowadays need to be schooled and to understand what the practices are relating to Islamic finance. Now, in its essence, the Islamic finance prohibits the payment of interest according to the Quran, and therefore it is incumbent on a CFO to understand that if they want to raise long-term debt from Middle East or Islamic sources, they need to structure the instrument in a way which is appropriate and in accordance with Islamic law. So there's a number of instruments that are available, Islamic financial instruments that are similar to what in the West one achieves through trade credit, leasing, equity finance, and debt finance, but they have specific conditions attaching to them, which the student should be generally aware of. In other words, we have to know what questions to ask to be able to structure the funding in an appropriate way. Now, when a company is looking at funding a new project, we have what is known as the pecking order theory, and that is the preference by the company is to use internally generated funds first, and then debt, and then equity, which is the most expensive option for raising finance. So keep that in mind, and one should be in good shape. Also related to the issues of long-term financing is to take into account what the relationship should be between debt and equity. In other words, the financial gearing of the firm. Now, this is going to be an important discussion next time when we get into the next chapter on the cost of capital. So the student is invited to read through and think carefully about what the conditions are. Why does a company use debt in its capital structure? And just as important, how much debt is appropriate in the capital structure? When we speak of capital structure, we're talking about the proper combination of debt and equity. Now, the industry in which the company operates can have an influence on how much debt is wise to be used. And here are summarized a number of conditions or criteria that a company should take into account when deciding how much and in what form the capital raise should, what form it should take. Finally, financing for small and medium enterprises is really a different kettle of fish and has to be looked at separate from large companies that are listed on public exchanges, because small businesses have certain features. They're being smaller, they're difficult to sell, and therefore it's also difficult to raise capital for such entities. Therefore, such businesses are prone to practice overtrading, in other words, to trade with a deficient capital base, and in many cases this can lead to the failure of SMEs. Startups and SMEs historically have a rather higher rate of default than do large publicly quoted companies. So until next time, when we discuss cost of capital, do review and take into consideration the ideas which are expressed in this chapter. Thank you.